What is internal rate of return? How in the world do you calculate it? And why is it important to your investment decisions?
Welcome back, guys. Thanks for tuning back into our 5-part video series where today we break down internal rate of return. Again, I'm Colin Bauman. I'm a local real estate agent. We're with Sam Jones. He's at Vitality Capital Management.
Awesome. So yeah, internal rate of return, what is it and why, and how does Investopedia define it?
Yeah, we'll kick off by defining how Investopedia defines it.
I'm just going to say this before he jumps into that. I think it's important to realize this is what a lot of the finance world uses to calculate investments. This is kind of a standardized number. So it's good to compare real estate investments to standard financial returns.
Absolutely. And so the internal rate of return, it's a discount rate that makes the net present value of all cash flows equal to zero in a discounted cash flow analysis. Now that makes no sense, and just about any of you can probably pull up Investopedia and get that same thing. So today we're gonna actually define what that freaking means, right?
So simply put, it's your annualized rate of return. So say you put $100 into an investment, you get a 30% return one year, negative 10% the next year, 5%, and then 15% the year after that. Like, what does that all annualized average out to be?
Yeah, so what we've done here is we've taken my condo and we're gonna illustrate how, the annualization, how that would actually take effect and spit out an internal rate of return.
And it's important to realize that this calculation is done off of projections. So we don't actually know what we're gonna get, but this is a conservative projection.
Yeah. So just for off of our projection, we have a 20% down loan plus a down payment. It gives our initial investment, money coming out of our pocket, of $57,380. Now, once we make that investment, we get rented out, we start having some tax benefits pretty much right away. So there's money that we're making right away. And so after year one, we have this cash flow, and then year two, it just increases slightly over year.
Yeah, so it's important to realize that these are, after your expenses as well. We've talked about that in previous episodes. But then in your final year, you're gonna sell the home and get all the appreciation of the home, the loan pay down, and get all of that back from your initial $57,000 investment. And what that comes out to be is a 14.21% return.
And then after taxes, because that's actually what you're gonna be taking home, we get an 11.9% return.
So that's annualized each year. That's not just like one time, but you're getting that year after year if you average out your returns, which is pretty awesome and pretty big. And it's important, kind of like Colin said, like, what are you taking home at the end of the day? We really look at that and say, okay, what is this what are you investing, and how much are you going to get out of it at the end of the day, after taxes, after all your expenses and everything.
And so this is like the end all be all, I would say, formula when analyzing real estate. Now understand that it takes a lot to calculate this.
A lot.
You don't need to go into an internal rate of return on every single deal that you might potentially purchase. But if you're gonna move forward with a purchase, you know you like the location of it, you know what it rents for, you know the expenses, you know the repair budget going in, the loan product you can get. It's at that time when you'd wanna probably run an internal rate of return calculation. You're probably gonna use a calculator when you do this. And you're gonna run some projections and be conservative in those projections. Don't inflate those numbers, and be consistent with it when you're comparing it to other properties. But that ultimately is what you're gonna do, and you're gonna wanna do that so that you can know the end all be all of what comes home into your pocket.
Totally. And I love doing this analysis because it really makes you sit down and say, okay, look at all these numbers and really look at the investment as a whole and realize, okay, is this gonna be a profitable investment? Should I make this investment?
Absolutely, because there's a lot of real estate investors that, if you only look at like cap rate, for example, cap rate doesn't take into account financing. You might have expenses that come up that significantly reduce your cap rate. Or if you look at cash on cash return, and all of a sudden you're only looking at the cash flow of your property, you're not looking at the appreciation year over year. There's things that you are gonna miss with some of these other calculations. This calculation isn't gonna miss it. You can incorporate every single expense and every single gain that you could possibly have in a property into your internal rate of return.
Totally. And like Colin said, there's a lot that goes into this. And so we're gonna have a bonus video available where you can come and subscribe and get access to it. And we're gonna go through this actual spreadsheet and show you how exactly we get these numbers, which can give you a great idea of how to calculate these properties.
The other thing we'll give you is we'll actually give you a template of that spreadsheet so that when you want to run an internal rate of return calculation on a property that you're looking at buying, you can have access to our spreadsheet. You can go run it for yourself.
Totally. And this is a lot of what we do for our clients. Like, this honestly takes quite a bit of work, and a lot of times people want just a second opinion. Okay, am I running these numbers right? So we'll help them analyze and say, okay, yeah, this is a good investment.
To give you an example of like why it's difficult, why you need a second opinion, is somebody who's just stepping into the world of real estate probably isn't going to know a hyperlocal market's annual rent growth. And they're probably not going to know their annual appreciation. They're not going to have a whole view. They might not, this might be a young investor that has never experienced a 2008, it might happen. So there's all these other factors. That's why we as investors need a second opinion.
Totally. We're happy to give that to you, and we're excited to hopefully give you access to that bonus video.
Yeah, thanks for tuning in today, guys.